Hi everyone. Today we are going to see about profit prior to incorporation. Incorporation meaning the union of books of accounts of a subsidiary company with already existing company. Incorporation, it can be classified into two: pre-incorporation and post-incorporation. What is profit prior to incorporation? The partnership converted into a company or a existing company purchased by another company. We want to calculate profit prior to incorporation. Profit prior to incorporation is the profit earned or loss suffered during this period. Before incorporation, it is capital profit and is not legally available for distribution as dividend because a company cannot earn a profit before it comes into existence. Profit earned after incorporation is revenue profit, which is available for dividend. Pre-incorporation and post-incorporation. Pre-incorporation means the period before incorporation. For example, it will be started with accounting opening date to incorporation date. Post-incorporation period. Post-incorporation period means after incorporation. Example, it started from after incorporation to closing date. Example for pre-incorporation and post-incorporation period. Example, X Limited was formed 1/4/2012 to take over the period of business Y Limited from 1/1/2012. They are ended on 31st/12/2012. Calculate the pre and post-incorporation period. For example, here accounting year started from 1/1/2012 to 31st/12/2012. But the company will be taken over from 1/1/2012, but the incorporation will be held on 1/4/2012. So before incorporation period, it should be called as pre-incorporation. So before 1/4/2012, from January, we are having 3 months only: January, February, March. So pre-incorporation period is 3 months. The post-incorporation period means after incorporation. So it should be 1st April 2012 to 31st/12/2012. So here April to December we are having 9 months. So post-incorporation period is 9 months. Private company starts its business soon after its incorporation, whereas public company commences its business only after obtaining certificate of commencement from the registrar of the company. The profit earned before incorporation period of the company is termed as pre-incorporation profit. Profit incorporation after, it should be called as after incorporation period. The pre-incorporation profit is called as the capital profit. It transferred to capital reserve account. In case of the company suffer a loss prior incorporation, it's rated as capital loss. It's transferred to goodwill account. The profit and loss earned by the company after incorporation is called as the post-incorporation profit or loss. Step to be determine the pre-incorporation profit or loss. First step, prepare a trading account for the whole year. Step 2, compute the time ratio and sales ratio. For the example, we can determine the time ratio of the pre and post incorporation period is 3:9. Third step, prepare a net profit statement to analyze pre and post incorporation periods. Profits to be noted while preparing net profit statement. Gross profit calculated on the basis of sales ratio. That means we want to classify the gross profit on the basis of sales ratio. The next one, dividing all the standard expenses or fixed expenses time ratio. For example, sales ratio: sales, rent, printing and stationery, telephone charges, postage, telegram, general expenses, depreciation, administrative expenses, audit fees. All the time-based expenses will be classified on the basis of time ratio. That means pre-incorporation period and post-incorporation period. We want to use only time ratio. Divide all variable expenses on sales ratio. Example, carriage outwards, advertisement, salesman salaries, commission, brokerage, bad debts. That means all sales relating expenses we want to segregate with the sales ratio only. Salary of partners, interest on purchase, consideration, interest on vendor capital are to be charged to pre-incorporation period. That means certain expenses only we can use for the period of pre-incorporation period. It will be posted in the heading of allocation. some expenses exclusively belonging to the post incorporation period and they have to be charged post incorporation. Example: managing director's salary, director's fees, debenture interest, discount on issue of shares, discount on issue of debenture, preliminary expense, writing of underwriting commission return. For example, if the partnership firm converted as a company, the director will be appear only after the company. So the expenses will be only used in the post incorporation period. It should be sourced in the heading of allocation. Audit fees can be divided into pre-incorporation period and post-incorporation period based on time ratio. Audit fees can be also be charged exclusively for the post-incorporation period, assuming the auditing fees compulsory for company only. Bad debts recovered can be charged or both the period of depending on where it relates to. Interest received can be charged for both the period based on sales ratio. Assessment time. Kindly answer the following questions. How can be a business owner describe the concept of profit prior to incorporation in the context of startup? What are the second question? What are the some key factors to be considered when providing a descriptive analysis of pre-incorporation profit for a potential business venture? Thank you.